There's two key things to focus on for the front part of the week, and that is this gold move. But also we need to revisit what's going on with the euro. So we're going to have a focus there. And then we're going to move on to some European data that's come out today, which doesn't look too great, and the ECB is probably watching. And today's Trading Takeout is going to be why it's important to try and objectify what your edge in the market is. Make sure you subscribe and like this video so I pop up in your YouTube feed even more, because really you have to be watching every day to ensure that you can maintain your trading edge. So the biggest move of the week outside of crypto, which we're not going to talk about because of certain regulations, but the biggest move overnight has been gold. To me, it looks like a really low liquidity fat finger. So someone's accidentally gone and bought, maybe 10, 100 times more than what they wanted to, because that is a completely anomalous move. It's moved up over $100 there. Over the space of, sorry, not $100. It's moved up. Yeah, nearly $100, actually, nearly $100. So ridiculous move. Looks like a fat finger. And of course, you can see the market's being completely faded there. I've said today already to some guys that chasing a move like that when it was a lot higher, fear of missing out and that kind of thing is where you're going to go wrong. And subsequently, it's about $30 lower from where I said that. So it is what it is. If you see moves like that, especially in overnight conditions and not during the main trading sessions, you can tend to deduce that someone's done something wrong, whether it's an overnight intern or something like that. Someone's on the chopping block today, basically. That's pretty much what I'd take from this gold move. There's no macro drivers from it. There's nothing going on necessarily there. So wouldn't take too much from it. Lots of people have been reading into it. To me, it looks like a massive fat finger. Someone is either losing their job or is going to have to make up their P&L massively for, the year's nearly done. So maybe they've got a couple of weeks left, 2 weeks or something to make it back. But yeah, it doesn't really look like anything substantial to me, anything with substance. So ignore basically that gold move. But what we shouldn't ignore is the euro, purely because a lot of data has come out this morning. German data, weaker exports and import data. So there is a lot of, trouble with demand in and out of Germany. There's not demand for German goods. German cars, obviously, global slowed down to an extent. That's their main export base, or one of their main export bases. Less demand for that. There is, less demand for imports into Germany, showing a reduced German demand. And I think this is going to weigh on the euro significantly. I've been saying it for a long time now. And it's a long-term view thesis. It's not something that you intraday trade or anything like that. This is, structurally, what is wrong with the euro? Build a longer term view around that. What that would maybe mean is, sell broader rallies like we've seen back into the key level on the 15-year resistance line. It's basically something to bear in mind constantly whenever you're seeing the market retrace back into a key sort of technical level or something like that. Alongside that key level as well, let me just add in this, because I believe I saw this the other day. 200 weekly moving average. Perhaps it wasn't the 200 week, but you can see basically that we've retested back in July, the 200 week. And we've tried to test again that trend line. Personally, I think we're very much capped on the euro. I say it over and over again. I do look at different timeframes to most people, so I'm looking very much longer term. I look at structural issues over the long term. For example, I think there's about to be a fantastic trade on Swiss yen coming up to the downside. I'm probably going to talk about more about that after Christmas. I think it's going to be a real strong pair. And I think, over the longer term, the euro is structurally there to facilitate German trade, German mercantilism. And so by that logic, you follow it that the euro really needs to get weaker for the German economy to recover. And that is the primary way that they can make it more flexible. And the way that they do that is by reducing interest rates. So I would expect the ECB to be the first to cut out of all the major economies, well, the major central banks, of course. So bearing that in mind, whenever you see a key technical level after the market has rallied into it, use the macro then to say, okay, well, this is a better risk to reward than I could have had it when it was a little bit lower or higher if it's vice versa. That is the way that macro should be looked at. People say, oh yeah, it's all in the chart. Well, okay, if there were no macro, then you wouldn't even have a chart. So disregard that. They're just trying to make themselves feel better. It's just another way to understand and rationalize where the flow is going to go, basically. That is all the market is. The market is purely flow driven. It's just that some flows are stronger than others at certain times. Just going to quickly run through that worsening European data that I had mentioned in the previous video. So the German exports and imports, negative 0.2%, expected was 1.1%, so a massive miss there. German imports, negative 1.2%, expected 0.8%. So again, really strong miss there, not good. And then we come down to the Swiss CPI, which obviously isn't a part of the Eurozone. But Swiss CPI was, a big miss as well. 1.4% with the expected 1.7% on a year-on-year number. Now, this is where I was referring to that Swiss yen trade. I think that the delta or the difference in spread between bond yields is really going to close there very quickly on the Swiss yen. And I think that is one broad factor that we have to consider. And this is going to be part of the trade after Christmas. But the German export data, not good. We've got a couple more bits later. So we've got a few of the ECB speakers, and you can see next to their names, you've got De Guindos, Dove, Elderson neutral, Lagarde neutral, etc. They're all neutral now, basically, or dovish. And so what I think this means is we've got to pay attention to when these, sentiments change. When does Elderson, for example, shift to dove? When does Lagarde shift to dove? Because that will be a sign that interest rate cuts are coming quick and fast. And that will absolutely lead to a deterioration in European interest rate futures pricing, and therefore the likelihood of an ECB rate cut coming sooner rather than later. So it's really important that we grasp the volatility or velocity of what's about to happen within the macro sphere because of how European data is worsening quite rapidly. So something that is a little bit difficult, I would say, in trading is to understand exactly what factors are making you profitable. Now, for me, it's much less about the strategy and more about understanding whether there is an implied probability increase or decrease between doing one action versus another. So it's not about quantifying necessarily, but it's about trying to create a framework in your own head that would permit you to be in the most probabilistic, advantageous position at each moment. So let's take, for example, risk management. If you are able to objectively say that you can risk a decent amount each trade without blowing up, that is advantageous. Okay. If you're able to, say, use the macroeconomic side of things in line with the technicals, that is equally advantageous as well. So being able to really, really focus on those elements that are within your control, that have been repeated previously, that you understand to be profitable, is definitely the things that you should be writing down and focusing on every single time you look to analyze a market and then execute.